Welcome, investors and strategic partners. Today, we are diving into the 2026 outlook for Ashok Leyland, a titan in the Indian commercial vehicle landscape. As India's second-largest manufacturer of commercial vehicles, Ashok Leyland is not just a legacy brand. It is a high-growth engine positioned at the intersection of infrastructure development and the green energy transition. Currently commanding a significant presence in the medium and heavy commercial vehicle segment, the company is poised for a multi-year breakout. In this presentation, we will explore why institutional investors are increasingly bullish on this stock as we approach 2026, focusing on market share gains, technological pivots, and robust financial health. The core of Ashok Leyland's strength lies in its medium and heavy commercial vehicles, or MHCVs. By 2026, the company aims to maintain and exceed its 32% market share in this category. Driven by the Indian government's massive capital expenditure on roads and highways, demand for heavy-duty tippers and haulage trucks is at an all-time high. Furthermore, the mandatory scrappage policy is acting as a massive tailwind, forcing the replacement of aging fleets with newer, more fuel-efficient models. This structural shift ensures a steady pipeline of orders over the next 3 fiscal years, providing clear visibility for revenue growth and operational stability. Looking toward 2026, the real game changer is Switch Mobility, Ashok Leyland's electric vehicle subsidiary. The global shift toward decarbonization has put Switch Mobility in a prime position, with a focused strategy on electric buses and light commercial vehicles. With an investment of over $1.2 billion planned for the EV ecosystem, they are not just manufacturing vehicles, they are building an integrated e-mobility as a service platform. By 2026, we expect EV contributions to represent a double-digit percentage of total revenue, capturing the rapidly growing urban transit market in both India and Europe, making it a key attraction for ESG-focused venture capital. Financial discipline is the bedrock of the Ashok Leyland 2026 outlook. The company is aggressively targeting an EBITDA margin expansion to the range of 12% to 14%. This is being achieved through a combination of favorable product mix, cooling commodity prices, and stringent cost control measures. We are seeing a healthy return on equity and a significant reduction in debt-to-equity ratios. For VCs and angel partners, this signifies a de-risked balance sheet with high cash flow generation capability. As revenue scales with the infrastructure boom, the operating leverage is expected to drive net profit margins to record levels by the 2026 fiscal year end. Ashok Leyland is evolving from a regional leader into a global contender. The 2026 strategy involves diversifying revenue streams by expanding into the Middle East, Africa, and Southeast Asia. By establishing local assembly plants and robust distributorships, the company is mitigating the cyclical risks of the Indian domestic market. The goal is to increase export revenue to 15 to 20% of the total turnover. Their dosed and bota-dosed LCV platforms are specifically tailored for emerging markets, offering high durability at competitive price points. This international expansion provides a significant buffer and opens up new high-margin growth avenues for long-term investors. A unique advantage for Ashok Leyland is its deep-rooted partnership with the Indian Defense Forces. As the largest supplier of logistics vehicles to the Indian Army, this segment provides a high-margin, non-cyclical revenue stream. With the government's Atmanirbhar Bharat, or Self-Reliance Initiative, Ashok Leyland is securing larger contracts for specialized armored vehicles and high-mobility transporters. Beyond defense, the company's power solutions business, providing engines for industrial and marine applications, adds another layer of diversification. By 2026, these non-CV businesses are expected to contribute significantly to the bottom line, providing a safety net against traditional automotive cycles. Analyzing the stock's potential, analysts see a compelling valuation case for Ashok Leyland heading into 2026. With projected EPS growth of 20-25% CAGR over the next 3 years, the stock is trading at attractive PE multiples compared to global peers. Many institutional reports suggest a price target reflecting a 40-50% upside from current levels as the MHCV cycle peaks and the EV story de-risks. We are looking at a company that is successfully transitioning from a traditional manufacturer to a tech-led mobility solutions provider. For VCs and angel partners, the entry point now offers a rare combination of value and high growth momentum. In conclusion, Ashok Leyland represents a premier investment opportunity in the commercial vehicle space. Its dominant MHCV position, the aggressive EV pivot via switch mobility, expanding global footprint, and lucrative defense contracts create a diversified and resilient growth profile. By 2026, the company is set to emerge as a leaner, greener, and more profitable entity. Whether you are looking for a cyclical recovery play or a long-term sustainability bet, Ashok Leyland checks all the boxes. We invite you to look closer at the data and join us in this journey as we drive toward a high-performance future. Thank you for your time.